Welcome back to the Deep Dive. We've got a fascinating set of sources here, really covering the big moves in crypto for, the week of November 3rd through November 10th, 2025.
That's right. And it feels like more than just a busy week. Some real foundational stuff happened.
Yeah, definitely felt that way. Lots of noise, so we're here to cut through it for you.
Exactly. Our mission today really is to connect the dots. You've got these big macro liquidity events happening. Where's the money flowing from?
Right.
And then underneath that, there's some pretty critical tech development going on. We need to link those two. Structure, not just hype.
Okay, structure. I like that. So we've kind of organized this into three main threads, is that right?
Yeah, three areas that seem to be weaving together. First, just how global liquidity is, flowing back in.
The money tap turning back on?
Sort of. Second, how some of these regulatory walls are actually starting to come down globally.
Interesting. Okay.
And third, the core tech itself, finally tackling some of those big scaling problems that have been hanging around for ages.
Got it. So, liquidity, regulation, tech. Let's kick off with segment one then. The money, liquidity, and the macro stuff pushing it.
Right. And what jumps out immediately is how the market reacted. Bitcoin's price action. Well, it pretty much confirmed that historical November effect pattern people talk about.
How so? What did it do?
Well, it bounced back strong from that slump we saw, and then it broke through pretty decisively, actually, that crucial $115,000 resistance level.
Okay, hold on. Why is $115,000 so important? Is that just a number or?
No, it's significant. It was basically the high point from the Q3 rally, a big psychological level.
Ah, okay.
The market had tried, twice before to break it and hold it and failed. So getting past it and staying past it, that signals real momentum. And the November effect, that usually suggests money rotating out of traditional stuff starts picking up speed around now.
Okay, so the chart looks bullish, technician approved.
Yeah.
But what's actually driving it? We saw institutions flip right after pulling money out.
We did. It was a pretty robust reversal.
What were the numbers? Was it just a correction after they got spooked, or is this real commitment coming back?
It feels more significant than just a correction. I mean, after 2 straight weeks of outflows, which were pretty painful to watch, U.S. spot Bitcoin and Ethereum ETFs pulled in a combined total of $900 million in net inflows.
$900 million. Okay, that's not insignificant.
Not at all. It suggests the institutional panic, or maybe just caution, has eased up. Capital is actively moving back into risk assets, and pretty quickly, too.
And that speed, that velocity, you really see it when you look at the real-world assets base, RWAs.
No.
BlackRock's fund, BUIDL.
Yep, BUIDL, their tokenized U.S. Treasury fund.
It crossed $5 billion in assets under management. That sounds like a huge milestone.
It absolutely is. $5 billion, that's not experimental anymore. It basically validates the whole RWA tokenization idea. Not just as a concept, but as something that works at scale for the biggest players out there.
So it proves the model.
Exactly, and it does something else, too. It puts pressure on everyone else. If BlackRock can comfortably run a $5 billion tokenized fund, every other major financial institution has to be looking at that and thinking, we need to catch up. It gives them cover, makes the infrastructure look viable.
Okay, so institutional structure is firming up. Then we pivot back to just, raw cash injection.
Yeah.
The U.S. government news.
Right. The shutdown ended. That was crucial first. Just stabilized market nerves almost immediately.
Always does.
But then came the headline. President Trump pledging that $2,000 direct stimulus check.
Ah, the stimulus effect again.
Yeah, direct payments to eligible citizens. And we've seen this movie before, haven't we? That kind of money injection often finds its way pretty quickly into risk assets, crypto included.
So this is interesting. We're talking about a big slug of retail fuel potentially coming in. Is the expectation that this $2,000 promise could really kickstart another wave of retail interest like we saw in previous cycles?
Well, historically, stimulus definitely provides that initial, let's say, speculative fuel. Absolutely. People get a check. Some of it goes into the market.
But is it different this time?
I think the key difference now is the context. While that retail money might be coming, the global infrastructure around crypto is maturing. It's getting more regulated, more legitimate places for that capital to actually land.
Okay, interesting. So the pipes are getting better, built just as more water is about to flow through them.
That's a good way to put it. Which leads us pretty smoothly into our second segment, actually. Global adoption and those regulatory barriers starting to fall.
Perfect transition. And the biggest news on that front this week wasn't even in the U.S., it was Asia, Hong Kong. What's going on there?
Yeah.
Seems like a huge step.
It really is monumental. The Hong Kong Securities and Futures Commission, the SFC, they gave preliminary approval for the first spot Bitcoin and Ethereum ETFs in the region, and crucially available directly to retail investors.
Wow. Retail access in Hong Kong for spot crypto ETFs. Why now? What's the driver?
It establishes this really significant regulated gateway for Asian investment capital. It's basically formalizing crypto as an asset class that a huge pool of retail wealth can now access, but within a framework they trust.
So it's about capturing those flows, keeping that capital within their regulated system.
Precisely. Hong Kong is clearly positioning itself. They want to be the regulated hub for digital assets in Asia, make sure that wealth stays local, but still gets exposure to this new asset class. It's a competitive move.
Makes sense. Meanwhile, back in the U.S., things are getting clearer for the traditional players, the banks. The Treasury Department put out new guidance.
Yes, detailed consolidated guidance, specifically for state and federal banks, and it focuses right on stablecoins.
Okay, what does it clarify?
It lays out clear standards for how banks should handle reserving, auditing, and even issuing stablecoins.
Yeah.
Before this, banks were kind of operating in this murky gray area.
Yeah, that was a big blocker, right? The uncertainty.
Huge impediment. This new guidance basically gives them a rule book.
So does this clear rulebook give U.S. banks an edge now? Can they finally launch their own properly audited reserve stablecoins? Or does it maybe restrict them too much compared to the DeFi native ones?
It definitely speeds up their entry, no question. Having that clarity on compliance, on risk management, that's what regulated institutions need. So yeah, expect banks to move faster on their own stablecoin projects now.
But maybe less nimble than DeFi.
Sure, they'll be more restricted than, say, an unregulated DeFi protocol, but their competitive advantage isn't speed, it's trust. Those clear auditing and reserving standards, that's what their institutional clients demand. That's the foundation.
Trust through regulation. Got it. Okay, but away from the regulated giants, what about the native ecosystems? Solana was making noise again.
Yeah, you can't ignore the decentralized side. Solana hit new all-time highs in some key metrics, daily active users, total value locked in as DeFi protocols, both reportedly at record levels.
What's driving that surge? Is it still the speed and low fees?
That's a big part of it, yeah. The success of its high-speed decentralized exchanges, plus some new projects catching retail interest, it's still got that grassroots energy.
So here's a thought. Is Solana's success happening despite all this new institutional focus and regulation? Or does the clarity for banks, like the stablecoin guidance, somehow make retail users feel, I don't know, safer playing around on these decentralized platforms? Like the whole space is less Wild West.
That's a really interesting question. It's probably a bit of both, you know?
Yeah.
Institutional clarity definitely brings a certain confidence to the whole market, helps normalize crypto generally. But Solana's growth also shows there's still massive demand for that fast, cheap, bottom-up innovation. The market seems to need both lanes, the regulated institutional ones and these high-speed decentralized ones.
Two parallel tracks, maybe feeding each other.
Yeah.
Okay. And speaking of those decentralized highways, that takes us to our final segment, the tech, the engine under the hood. Because if that engine can't handle the load,
all the money and adoption in the world won't matter if the core tech breaks or gets too expensive. Exactly. And a major long-standing pain point, especially for Ethereum, has been transaction costs on Layer 2 networks.
right, L2s are supposed to fix high fees,
Yeah.
but they can still be pretty volatile themselves sometimes, which isn't great if you're building an app.
It's terrible for builders, hard to predict your costs. But now, Vitalik Buterin himself, Ethereum's co-founder, has introduced a new proposal, EIP-X.
Okay, EIP-X. What's the goal?
It aims to standardize how these Layer 2 networks pay for something called data availability.
Data availability. How does standardizing the payment for that help a builder? What does that actually mean for costs?
Okay, so data availability. That's basically how L2s prove their batch of transactions is valid back to the main Ethereum chain. Think of it as the cost of security, the cost of borrowing Ethereum's trust.
Gotcha.
EIP-X wants to make that cost much more predictable and significantly lower. If you can do that, you directly slash the operating expenses for every single project built on an L2.
Oh.
Imagine you're running a big decentralized exchange. If your security costs swing wildly, it's really hard to build a profitable, sustainable business, make it predictable and lower. Suddenly, it's much more viable. It stabilizes the whole L2 ecosystem.
Provides that predictability needed for, like, enterprise-level stuff, maybe?
Exactly.
Yeah.
But tech improvements aren't just about scaling and costs. It's also security, evolution.
Right. And we saw movement there, too.
Yeah, a couple of significant things. Euler Finance, remember they had that major exploit last year?
Vaguely, yeah. Big hack.
Well, they just successfully completed their full relaunch. And crucially, they incorporated much stronger security measures based on what went wrong. Coming back from a hit like that and rebuilding stronger, that sends a huge signal of trust to the community.
That's resilience.
Yeah.
And what about their competitors? Aave?
Aave isn't sleeping. They just released the final design specs for Aave V4, their next big upgrade.
V4, what's the focus there?
Two key things jump out: enhanced modularity and better cross-chain governance.
Modularity, meaning you can swap parts in and out.
Pretty much. Imagine being able to easily plug in a new type of collateral or a different way to handle liquidations without having to overhaul the entire system. That kind of flexibility, that's where DeFi lending seems to be heading. More adaptable, more interconnected across different chains.
The system gets more flexible, more robust.
Yeah.
Okay. And finally, maybe the ultimate sign of the market growing up, NFTs. I remember when it was all just about cartoon apes. GameStop's latest move feels different.
Yeah, completely different. It feels like, well, like an admission that the purely speculative frenzy is largely over.
What do they do?
They launched version 2 of their NFT Marketplace, and the core change is profound. They're pivoting away from just speculative digital art
Towards what?
towards utility, specifically utility-based gaming assets, in-game items, things that actually do something within a game.
Ah, so NFTs with a purpose tied to gaming. That feels like a big shift for the whole NFT space, not just GameStop.
It really is. It kind of confirms this broader market transition. NFTs finding their footing with actual use cases, especially within the massive gaming sector. The asset needs to have a function to justify long-term value, not just be a digital collectible. It's utility finally meeting adoption in that space.
Okay, let's try and tie this all together then. Synthesize these threads. We've got market momentum, confirmed by Bitcoin breaking $115.
Right, fueled potentially by stimulus retail money coming in.
Then institutional validation, like BlackRock's BUIDL hitting $5 billion, showing RWAs can scale.
Plus clearer rules for banks from the Treasury on stablecoins, and Hong Kong opening that big regulated gate for Asia.
And underpinning it all, the tech debt getting paid down. Vitalik's EIP-X making L2s cheaper, more predictable.
And protocols evolving, like Euler coming back stronger and Aave pushing towards V4's modularity.
And even NFTs finding real utility in gaming.
Yeah, I think the big picture here is convergence and maturation. You've got the macro environment stabilizing and providing liquidity. At the same time, the institutional plumbing is getting seriously built out, the guidance, the scaling funds.
Right.
And right beneath that, the core technology is finally fixing some of its biggest bottlenecks while also getting more secure and flexible.
So the takeaway really is, the market's growing up. It's focusing just as much on attracting serious capital as it is on actually solving the underlying utility and scaling problems. The infrastructure, maybe for the first time, looks like it might be ready to handle the kind of capital flows we're starting to see or might see soon.
Exactly. Which leads to a final thought, something for you listening to consider. What stands out to you in all this? Think about it. You have global regulatory gates, like Hong Kong, swinging open, just as a potentially significant liquidity injection, that $2,000 stimulus, might hit. And it's hitting an ecosystem that's shifting hard towards utility, like GameStop's gaming NFTs.
Okay.
If all those things converge, easier access, more money, and assets that actually do something, what could the real, maybe longer-term impact be on where global capital decides to flow? Something to chew on until our next deep dive.